Mike Lee with me this morning to watch the market for us. Inflation hotter than expected, 8.3%. Does that change your stock market outlook for the rest of the year?
Stuart, not so much. It's more next year where it changes it. This 0.6% month over month at this point in the cycle is shocking. It's terrifying. It means this inflation is a lot stickier than we expected. And if you look at the contributors to this, particularly rent increases, how do you fix that? At the beginning, it was used cars and hotels. Okay, that seems to have subsided, but how do you come up with more rental units? How do you stop this tide of rents increasing? And it's the people at the bottom that are getting squeezed with higher gas prices, higher food prices, and rent. So I think we're entering a recession unseen like any other, where the bottom half are going to get devastated, and those in the upper quarter to upper 10% will spend less, not do as well, but pretty much weather the storm. So this gap between the rich and the poor is going to get wider and wider. There's
no question on mind that a recession is coming?
I would say we are in a recession. We had 2 quarters of declining GDP. And so it's the degree, it's how deep does it get? How long does it last? I would say that what happens today is that Fed pivot is further in the future. So those, a month or so ago, we were expecting it at some point in the first or second quarter of 2023. I don't think that happens till 2024. I'd say the good news for stock investors is most large institutional investors were priced in just this. They were expecting this. They're already bearish. So I do not see the bottom falling out of the market.
I'm going to go back to the same old question. I think I've asked you before. At a moment like this, what is wrong with me going out and buying a 2-year Treasury which yields me 3.73%. If I hold it to maturity, there's no risk. I'd get all of my money back and 3.7%. What's wrong with that?
There's absolutely nothing wrong with that. Although in a month or two from now, you may be able to buy it at 4%. And that's that. So you could be reinvesting those interest payments at higher coupons. So as a cash alternative versus, because most checking and savings is paying 0, it's a good idea to be out there buying those short-term treasuries. Maybe add some dividend stocks too.
But you see, I wouldn't be maximizing my income. I would be minimizing my potential loss. That's what I'll be doing.
Yeah, absolutely.
That's a very defensive position in a market like this.
That's in large part what the Fed wants. They want to risk off money out of the system to slow the economy down, so inflation slows down with it.
Would you like to make any kind of prediction about where is the bottom for the S&P 500? It's right at 4,000 now.
So I'll be interested to see if we take out roughly 3,900, which is where we were a few weeks ago before we bounced off that. I do not think we go back down to the levels we were in mid-June. Once you rally 17% off your low, you typically don't go back and retest that, and you never look back. So I think we're going to be in this choppy trading range for longer than previously expected. But I do not see the bottom falling out, nor do I see the market taking off.
It's tough for you guys as investment advisors, isn't it? That's really a tough marketplace to be in.
Yeah. So I use a system. It's worked really well. My largest equity holdings have been the energy sector, staples, and utilities. So that's dramatically outperformed the S&P 500 this year. I have a good system that somebody else much smarter than me helped me put in place, and so it's better to be lucky than good. So
better to be lucky than good. Yeah, I'm with you on that one. All right, Mike Lee, thank you very much indeed, sir. We appreciate it.
Thank you, Stuart.